Hello, I'm Robin Gibson, and this is your Harvard House Money Morsel. Welcome back. Thank you for joining us. Please don't forget to like and subscribe. Click the bell so that you get a notification of when we release a new video. I'm sitting again with Michael Porter, Chief Investment Officer of Harvard House. Welcome, Michael.
Morning.
Michael, we've seen it's been another week of wild events, lots of volatility as we've been talking about. Please just sort of describe some of the events that have been going on there that have driven markets this last week.
Yeah, morning, Robin. We sit here on a beautiful morning, but if we think back a week, the Ukrainians blew up a bridge in Crimea.
Yes.
And the Russians retaliated strongly and are now threatening a veiled threat of sort of nuclear war in Europe, which is unthinkable. The UK is blowing up its credibility with their backwards and forwardsing. It makes our finance ministry and our look like the Fed in terms of stability. And then everybody's been waiting this week for US CPI, which is the big number that came out yesterday as a sort of up-to-date gauge of where inflation is. And so let's explore that for a moment because market movements, so the whole week the market's been really volatile. It's been quite weak. I think the rhetoric out of Europe is really not great at the moment. And, it's really hard to see a resolution to this war, if you want to call it like that. Actually, one of our local stockbrokers had dinner with the Ukrainian ambassador in Joburg this week. Mm-hmm. And the message from him was actually, until Russia's out of Ukraine, there's no chance of resolution, and that's miles apart. So we've obviously got a road to travel on that. But US CPI came out, the market was waiting for it, and the number was expected to be 8.1%. It came out at 8.2. Now, 0.1% you can argue is negligible, but within 20 minutes, the market and the Dow futures and S&P futures had fallen about 3%. Because not only was inflation, marginally higher than anticipated, but also core inflation, which takes up petrol and energy prices and things like that, was actually ticked higher as opposed to sort of rolling over. Yeah. And the market just plummeted. By the end of the day, the market was up 3%. So we were down 3% after 20 minutes and up 3% by the end of the day. I mean, a 6% swing in one day is just crazy.
Yeah. So, Michael, is that sometimes we see the market do these things? The number looks a little bit concerning, and then we see this movement come a little bit later. Is this where guys take the time to dig in a little bit further, and then because the markets are forward-looking, they see something different coming down the line, which almost breeds a little bit of optimism? Is that really how markets work?
Yeah, I think so, Robin, exactly. I mean, we have this sort of colloquial saying in the markets that good news is bad news and bad news is good news, and it can get really confusing. And actually, at the moment, almost what you're wanting is for the news to be poor, because that, if you have poor economic news, that basically implies that the Federal Reserve, the economy is weaker than expected, and that will give the Federal Reserve some comfort that the interest rate cycle is close to its peak, and that interest rates will, at some point next year, start leveling out and declining. Mm-hmm. And so that's how the market interprets it. Mm-hmm. So yesterday was a classic case of the number came out, it was higher than expected. That was essentially bad news is bad news. So that was interpreted like that.
Yes.
And the market fell. And then when you start looking into the numbers, there are a lot of categories where prices are coming down quite sharply. And I mean, listen, there are categories where prices are not coming down, but there's a lot of categories where prices are coming down. I mean, one of the most sticky areas of inflation is the housing market and rents and rents going up, But I mean, if we actually look at the housing market, there's no doubt that there is weakness in the housing market coming through in terms of sentiment, in terms of home sales, in terms of mortgage rates at sort of 20-year highs. I mean, it's never been more expensive to buy. Well, in the last 20, 25 years, this is the most expensive it's been to buy a house, from the fact that nominal prices have gone up, so the value of your house you have to pay is obviously gone up, and then interest rates have gone up such a lot. Yeah. So there are things in those numbers that point to the fact that inflation can soften, but I think it's also just a reflection of the fact that sometimes markets are irrational on the downside and the upside,
Yes.
and this week we've actually had, yesterday was Thursday, so we've had 3 days, Monday, Tuesday, Wednesday, where markets were sort of, chugging along, and then in the last hour or two, they got sold off heavily and closed negative. And, so I think in some ways, for whatever reason, yesterday you interpret the data a little bit differently, and there's probably a little bit of pent up. It's probably been oversold a little bit in the short term, and markets rally a bit. But so I wouldn't read too much into yesterday's rally. I don't think that necessarily things have changed. But I mean, obviously, what we are into at the moment, what we also talked about, is that US companies are reporting at the moment. So PepsiCo came out on Wednesday with their results for the quarter. Pretty good. Now, PepsiCo is a huge company. We eat and drink their stuff all the time. It's less precious, but they're holding their own. I think last night, JP Morgan came out, and the banks rallied hard across the world yesterday, and Citibank, I think, is today. It might have been last night too, or today. And so as we get into US reporting season, the market will definitely take its tune now from just how well companies are doing and how well they're navigating it, and kind of how they see the next 6 to 9 months. I mean, if the outlook is reasonably upbeat, I think the market's going to rally into the last quarter.
Yeah.
If the mood is pretty negative and every CEO is standing there with a long face saying times are tough, then we're probably in for a tough fourth quarter.
Yeah. So we've been banging on about inflation for pretty much most of this year. But that still is the story, and it's really about the trajectory of inflation in the US, isn't it?
Yeah, it's all about inflation. It's all about when interest rates are going to stop rising, and when, because interest rates are a brake on valuations. We've talked about that quite a lot in Intuition. At some point next year, inflation will peak, interest rates will peak, and we'll start looking through that into the other side of the valley, or the other side of the cycle. So, the longer every month, every day that goes by, we're getting closer to the end point, Rob.
Yes, yeah. Well, Michael, thanks so much for colouring that for us. Folk, thanks for joining in. Don't forget to like and subscribe, and join us next time. Thank you very much.